Hi everyone, welcome to the second part of lecture week's one's video tutorial. So continuing on the previous section, so we are going to group the tradable assets into 4 classes. So first we have the equities, so which means the stocks. Second type we have the fixed income instruments, which include the bonds and annuities. So we have fixed income. The income is fixed. Third type, we have the cash and equivalents. So it's the cash, the most liquid form of assets, bank accounts, US Treasury bills, money market bonds. So which means you can use the money as we want. And we have the fourth others for the alternative investments class, which means they include the commodities, forex or exchange, rights, futures, options, ETFs, mutual funds, and hedge funds, right? And of course, there are other type of asset classes that can also be put into the alternative investments. Okay. We have so let's look at the PO function, right, for the derivative product. First one, we start with the futures contract. So when we enter a long position for futures contract, and basically what it says that we can and we are obliged to buy the assets, right, at a future date for a specific price. So if we denote the price as K, right, so the K is our price, and we're going to buy the assets at this price at a future date, and assume we're going to take the asset as a stock. So ST refers to the stock price at time T. So this is the current date T, small t, and this is the future date, uppercase T. So we need to buy the assets, buy the stock. Now the stock price is S uppercase T, and the beginning is lowercase t. So this is current stock price, and this is the price we can use to buy the stock, right? So of course there are three situations: situation 1, situation 2, situation 3. So situation 1, this means that our stock price is bigger than the price K, right? So what this means is that we are buying something, right? We're buying something that's actually for a low price. So this is our profit. So this gives our profit because this is our profit and it's bigger than 0, right? So we're buying something cheaper, right? And correspondingly, in the situation 3, the stock price is lower than the price K, which can also be called the strike price. Then we're actually buying something cheap, for higher price, right? So we're actually losing profits, right? So losing money, and that's what happens in the third situation. And the second situation is basically the future price equals the strike price, which is less likely. And correspondingly, if we enter short position, which means we're going to sell the asset at a future dates at a certain strike price, and this is the interest, the payoff is inversed. Okay, so the payoff function for the options contracts are more interesting. So now this is non-linear. So previously it's a line, it's a linear line, but now this becomes non-linear, and non-linearity comes in here, right? So the turning point. So if we long a call option, right? Long a call option, which means we're going to buy a call option. Now, what is a call option? A call option is a product that gives us the the option to buy certain assets at a particular price K, right? So this is the price K. So of course, if the price pointed at is at here, and if we're going to buy a stock, for example, the stock is more expensive, and then this is our profit because we can just buy it at the price K, which is lower than ST. So this is our profit. But in the case if it's here, right, is cheaper than the strike price, then we can choose not to exercise this option, right? Not to exercise means that we're going to forfeit the option. We're just going to lose the money we used to buy the option, which is much cheaper than the stock itself, right? And we're going to lose the transaction cost. But we choose not to exercise because this is the gap, right? This is the gap, and just can choose not to exercise. This is our pure function if we enter a long position for a short, for a call option. Okay, so now what do we mean by short-term call position? So, for example, we have a call position, right? So if we enter position to buy it, then the other party is gonna sell us. The other party is gonna sell us the short call position, and the other party is called short, right? So the other party is going short, we are going long, and this is all two parties, right? So we need to have two parties to make the transaction. So this is called short. So for the party that issues the option or that sells the option or shorts the option, also does the pay option free function back. So it's very straightforward. We just negate the opposing party's fill function. In this case, this is just negation, right? Negation. So this true. So you want to say negate, then this becomes this one. So meaning, as the price of the stock goes up, then the party that's entering the short position of the call option is going to lose more and more. So you see the loss is unlimited. So the risk is very high. Basically, that's what it's saying, right? So we are facing unlimited risk. Now, who would like to face this risk? Usually, it's the money institutions, but they are doing this for a reason, right? So if you predict that this situation is very unlikely, then you can enter this position, and the benefits, the profit for you is the transaction fee for the option, right? Because now people want to enter into a long position and they need to pay a fee to buy the products, to buy the call option product, and this fee goes to the selling party, right? So this is called transaction cost for the buyer, but this is the profit for the seller, right? And they take this risk because the reason they take the risk is because they want to make some profits. Okay, so that's for option. Put option is just the opposite also. So put option that you want to enter long. Put option basically it says that we have the right to sell something at a particular price in the future. Right? So if this is a price and if this is the strike price, then we can sell it, sell the other assets to this price. So if the price is lower than K, if this is ST, right? Basically what it's saying is that we are selling something that's for a higher price than current stock price, right? So we make some money, and this is the money we can make, right? So this is our profit. But if it's more expensive, right? We want to we sell something that's actually more expensive, then we can just forfeit the option. So in that case, our payoff is 0. Actually, it should be lower because this also be lower because there's a transaction cost involved, but we do not consider that in this case. Similarly, we just negate it if we enter a short position put option. That we just negate, and this is our risk. So of course, this is bounded because there's always the intersection point. All right. So let's continue. The trading value could be different places. Could be an exchange, could be a dark pools, broker markets where there's a middleman involved called brokers, right? So very popular. And also we have the over-the-counter markets. So it's a decentralized markets That's allowed direct transaction between buyer and seller, right? So it's compared to the regulated exchanges. Let's look at the process of executing a trade. So first, we need to get some information, right? Some codes. So say what's available in the market, and then when we decide to execute order, the order needs to be routed. So this includes the selecting the broker to handle the trade, or deciding which market to transmit, or to execute the trade, because we have different exchanges. And when it comes to executing the order, we need to match and execute it, right, between the seller and the buyer. So you want to sell or buy something else should always be the other party, right? Actually, we need to take the opposite position for the particular market. And finally, we have the confirmation, clearance, and settlement. Basically, some paperwork about recording and comparison of the records and settling the actual delivery of the security and its payments. Okay, so the structure of the markets in the past, we have the open offer, which literally people cry out to say what's the different assets being sold or people want to buy, right? So it's a big field where people shout very loud. Okay, so now it's basically program trading. So people use automated trading on computers to execute the trade. Okay, so now there's also a core market. Defined as a core markets. Core market basically means the trades are only allowed when the market is called, right? So it's tradable upon calling. We have the continuous markets. Basically, it runs at any time during the regular trading hours. Normally, the big exchanges such as the New York Stock Exchange or SGX, they are continuous markets. Code-driven markets, they are driven by the codes, right? So they are determined by the dealers and the market makers who participate in trades and match orders from their inventory. Right, so we have the based on the bids by quotations from the market makers or the dealers. The order-driven market is based on the again the buyers and sellers requirements for the number of shares they sell, and this usually includes the stock markets, for example, right? So if people say, I want to purchase 2 stocks at this price, then this is my order, and then put in the market, display it, right? And this applies to other assets as well. So this is more for stocks. This is more for bonds, currencies, or commodities, right? This is provided codes, and I say who wants to participate in the trade, right? So who can match the orders. Okay, so there are some major types of buy-side stock investors. So this is institutional investors, big funds, right, and then ETFs, sovereign funds, insurance, bank, corporate nominee, individual investors, startup, family business, just individual households. All right, so some more notions. Market making, what does it mean? So it means try to make a market. It includes 2 sides, buy side and sell side, right, for each particular security. And basically, the market maker provides the codes, right? So how much is they are going into to buy or sell, and ready to trade, and the corresponding volume. So the biggest role is that they provide the immediacy, right? So we can provide the asset immediately, and that means also the liquidity to the market. So you don't want to enter a position where it's very rare, and if you want to sell it, you cannot sell because nobody need to buy, right? Or very few people need to buy. Okay, so the market maker, it takes a significant risk because you are holding some stock, right? This stock is not the real stock, but you are holding holding some assets, and the price may drop, so you are facing that risk. Okay, so the notion of scalping is basically to make small profits, right? Make small profits which are very fast, and it describes some active traders who trade very actively. So I purchase some assets next hour and sell it, hopefully make some small profits. So which means that this can be very intensive. You need to monitor the markets very closely, and one big loss could eliminate many small gains. Right? So this is a type of trading, more for day traders or active traders. Portfolio rebalancing basically means we have a portfolio of assets, could be 30% stock, 40% bonds, etc. And because the price changes, right? So the market price alters and price changes, we need to rebalance so that it still fits our desired risk and reward profile. So this is called rebalancing. Basically, we are adjusting the proportion of each type of assets in the portfolio. All right, so this is the sample curve for the stock data. It's for a day, but the price could be hourly or minute. So this open price at the opening of the trading day, and it goes up and down. So the highest point is called high, and you have a low at the closing price. So these are the so if we were to summarize the price and the stock price for that day, then these are the points we would choose, right? So open, high, low, and close. And a common way to summarize the stock data is so-called the candlestick charts. Right? And depends on whether the ending the close price is higher than or lower than the open. So we have the bullish or bearish. So bullish on the left, and the closing price is higher than the open, right? That's why it's green. And this is the highest point. This is the lowest point. This is one way to summarize. We still have 4 points, and it summarizes how big is the real body, which is the middle, and what is going up or down, whether it's a bullish or bearish for that. Okay, so that's it for the second section, and in the third section, we're going to touch a bit about the coding parts using Python. All right, thank you.